Okay, let's continue on with ethics here. So here we have a diagram which kind of illustrates how public companies work and how they're kind of watched over by different parties. So there's several watchdogs, as I mentioned earlier in this chapter. First of all, you see at the center here, the public company. So to raise money, they sell shares to investors. They also borrow money from banks and other lending institutions. And they issue financial reports, which provide information to shareholders, potential shareholders, creditors, and government bodies, and so forth. Anybody external to the party relies on these financial reports for important information. So up top here, you see the provincial securities commissions overseeing the operations of public companies. So in any publicly traded exchange, there are some rules which must be followed by companies listed on the exchange. And the security commissions, if they feel like something has been violated, what they'll do is they'll suspend trading. And if it's really serious, they might delist the company from the exchange. So they really don't want that. So it's in their best interest to comply with what the exchange has set out as rules. Over here, you have decision makers. So anybody that give their money, either via investment or via loan to publicly traded companies, they're all very interested in getting regular reporting from the public company. So generally speaking, quarterly and annually, the company will provide a set of financial statements um, for decision makers to look at. However, before these financial statements go to the public, we have another party here called the independent accounting firm, and they perform audit, compliance, and advisory services. So the idea here is they look over financials to make sure that everything is fairly stated and in accordance with reporting standards, typically IFRS in Canada. So they'll give the okay that the financials are stated the way that they should be before they can go out to the public. So that gives the public a little bit of extra assurance that everything has been done properly because you have an independent set of eyes looking over the work. So part of the criteria for being listed on any major securities exchange is to have audited financial statements to report quarterly results. So let's expand on this idea a little bit. What is an audit? An audit is a financial examination conducted by independent accountants who express on whether or not financial statements fairly reflect the economic events which occurred during the accounting period. This audit process serves as assurance to financial statement users, so mainly external to the organization, that the information being presented to them is accurate. So looking at the standards specifically, we have GAAP, generally accepted accounting principles. These rules govern how accountants measure, process, and communicate financial information. So we'll be talking about all those elements: measuring, processing, and communication throughout the course. Historically, different countries have created and enforced their own gaps. However, the recent trend with increasing globalization and worldwide flow of capital, has pushed nations toward uniform accounting standards. Imagine that Rachel wishes to grow her company and chooses to finance the growth by issuing stocks on the American and Canadian stock exchanges. She would have to produce financial statements which conform to both American and Canadian GAAP. This process is redundant, time consuming, and costly. Now imagine that two countries had the same set of accounting standards. Rachel would only have to produce one set of financial statements, and potential investors could easily compare her financial performance to many similar businesses. This is especially true if the European and Asian stock exchanges also demanded the same accounting standard. So you kind of see where this is going. We've had a globalization effect take over in the last 30 or 40 years, and the accounting world has kind of adopted this or embraced this by having more uniform standards across the world. So here comes IFRS, International Financial Reporting Standards, a set of global accounting standards developed by the International Federation of Accountants. Since 2011, IFRS has been used by publicly traded Canadian corporations to report their financial results to the public. So IFRS is what publicly traded companies use and big firms with lots of money. For smaller firms, small businesses, they use something called Accounting Standards for Private Enterprises, or also known as ASPE. So these standards are designed for and generally used by small to mid-sized privately owned businesses. So smaller companies can use IFRS if they choose to. A publicly traded corporation must use the stricter standard. ASPE is usually the more cost-effective and convenient route for smaller businesses. As mentioned earlier, the users of financial statements can be very different for smaller privately owned businesses compared to large publicly traded corporations. So looking at an example here, a corner store owner may need a business loan from his local bank to open a second location. To assess the risk for the loan, the bank would ask the owner for financial statements which conform to ASPE. Since the bank can easily communicate with the owner, statements don't need to be as detailed or as comprehensive as an IFRS-based annual report to thousands of shareholders. By having a less strict reporting option, small businesses can often save a lot of money. So the idea is, say you have a company like Microsoft, you can't really call up Bill Gates and ask him, say, what's up with this? The corporation just has too much going on and there's too many shareholders to ask specific questions all the time. On the other hand, a small business is typically a lot more focused with a lot less broad activity. So the usually only the matter of calling up the business owner and getting clarification on something you see in the financials. It's a lot easier to do that. Let's go into some characteristics of useful financial information. One, it has to be understandable to users if they want to use it. You could have a great set of financial statements, but if the user can't understand them or make some kind of common sense of them, there's no real benefit to them. They also have to be relevant. So information has to be significant to make a difference in the user's decisions. To be relevant, the information should enable users to predict future outcomes or provide feedback about previous management decisions or both. So say someone hands me a set of financials and says, can you please invest in my company? And I look at the financials and I say, well, they seem like very detailed and accurate, but they're from 2015. Well, that's not necessarily going to give me a good idea of how the company is going to do going forward. So I might not want to invest in that. What will be a much better indicator for me is to get financial statements from 2015, 16, 17, 18, and so on. So get more recent data, which can help me make a decision, a better decision going forward. I can look at trends and I can also look at what's happening with the company recently. And they have to be reliable, right? So the information must accurately represent the impact of transactions summarized in the financial statements. The primary purpose of an audit is to ensure the reporting is free of error and bias. By having an independent third party look at the reporting of a business, I can feel more assured that I'm not being misled before I make my investment. And comparability. Information is much more useful if it's comparable to other information. Comparability can be useful in a historical context, where firms' recent financial performance is compared to past quarters and years. It can also be helpful to compare a business with other industry participants. IFRS aims to help this cause with uniform reporting standards worldwide. So a couple things here. I mentioned that if I have financials from 2015, it doesn't really help me unless I have more recent years. That's the component of relevance at play. What about comparability? If I can compare multiple years, I can see that the company revenues are going up or their expenses are going down. Something like that would help me, would encourage me to make an investment. I might also want to look at other competitors in the area. I might ask the person who's trying to push me into investing into her business. I might ask her, say, how is your competitor across the street doing? Are they doing better or worse than you? So I can compare the same company with how it's done in the past. I can also compare that company to its competitors or peers. So that's an important factor which I have to consider. So let's go through some other accounting concepts. First is the economic entity assumption or the business entity principle. The activities of a certain entity are to be kept separate from the activity of its owner and all other economic entities. The business is accounted for separately from other business entities, including its owner. So the idea here is that if I own a business and I report $100,000 in revenues, well, what I really should do is I should make sure that all those revenues belong to the business. So let's say I do some stock trading on the side in my personal trading account, and I made $60,000 last year. Well, all of a sudden, if I've included that 60,000, my 100,000 of revenues, that might mislead somebody. My actual business only made 40,000 in revenues, but I included the 60,000 which I made in my stock trading, and that would not be a very honest way to report what has been going on in my business. Going concern assumptions is pretty straightforward. It's a principle which allows the account to view an entity as a continuing business for the foreseeable future. It allows for recognition of expenses in future periods unless there is cause for concern, such as a business having to liquidate assets at fire sale prices. So the idea here is we can safely assume that a business will continue to function for the foreseeable future, unless there's real cause for concern, like evidence it's about to go bankrupt. So, for example, if the business has signed a 5-year lease, you can assume that the expenses of that lease will be on the financials for the next 5 years. Moving on to stable monetary unit assumption. When prices are relatively stable in a low inflation environment, accountants can assume that the purchasing power of a dollar remains constant. In reality, inflation occurs, prices rise over time, but the effect is generally ignored in accounting records. So in Canada, we typically have inflation year over year of 2 to 3%. So we can assume that we can compare numbers from last year to this year, or even the year before to this year. As long as too much time has not passed, we can assume stable money. Recognition, the process of including or omitting an item in the financial statements of a company. There's specific rules around what should be recognized and when. And we'll go into more details about that when we talk about revenue and expenses specifically with regard to this. But just make sure you follow exactly when you're supposed to recognize something and how much of it. How much of it relates to measurement, the process of determining how much of an item should be included in the financial statement. Once again, there's specific rules around this concept, such as the cost principle of measurement. This principle states that acquired goods and services should be valued at their historical cost. Because historical cost is a reliable measure, the business should continue reporting the asset's historical cost for as long as the asset is held. Cost benefit constraint, the benefits of information produced should exceed the cost of producing that information. So as an accountant, make sure you pay careful attention to this, that the solution you're recommending to the client, which might even be your own services, they don't cost more than the benefit that the client will derive from them. A materiality constraint, a piece of information is material if it can impact a decision maker's decision. Materiality is usually defined by the prepared judgment. For example, if a small grocery store's cash register was $5 less than expected at the end of the month, it's very different from variance of $500. So the example I like to use here is, say you have a small business owner and you have Microsoft. Small business owner has annual revenues of 100,000, and if a theft occurs and $20,000 go missing, that's pretty material, right? Because 20,000 out of 100,000 is significant. However, if that happened to Microsoft, which has millions, if not billions, in revenues each year, well, losing $20,000 is not so big. So if you notice that while doing work for Microsoft, you might say, yeah, we can include that in the financial statement, but it's not going to materially change anybody's decision. So you can safely omit that if you so choose. Okay, so that's it for now. I'll see you in the next video.